Welcome back to our lecture on topic 43, which is income tax calculations. And we are going to start with slide 11 of our topic 43. And basically here, this is the critical piece. We're talking about income tax calculations. And this is heavily tested on the CFP exam. So I highly recommend you take meticulous notes on this. So remember, income tax planning is only one subset of all the sections for the CFP exam. So first, in order to calculate your tax, you need to know the filing status. Is your client single, married, head of household, or a widow? And then you need to see how many personal exemptions they have. They will have themselves, obviously, but for head of household, they might have a child. Then you have to determine their gross income, but don't forget you subtract adjustments to get to their adjusted gross income. And then that AGI is reduced by whichever is greater, itemized deductions or standard deductions. So if the standard deduction is greater, you will use that. If itemized deductions are on Schedule A, if those are greater, you will obviously use those. You determine your personal exemptions. And then you calculate the federal income tax, and that's usually based on the adjusted gross income. If you have any tax credits, you subtract them. If you have to pay other taxes, you add them. So these are all the steps, and computers and tax software make this quite easy, but you still need to know, as a financial planner, you need to know what the proper filing status for your client is. Make sure every exemption that they can take, they can, the deductions that are allowable or not in their situations. So married filing joint is basically on the last day of the year or spouse died during the year. So you're either married on the last day of the year or your spouse died during the year. Now you could be a widow or a widower, and you can claim that for 2 years after the death of a spouse, but you must provide care for a dependent child and you can't remarry. So this is where the filing status gets tricky. So if you had just 2 people that were married, there is no dependent child, so they can't claim the widow status. Head of household is for a single taxpayer, and it's separated from spouse for the last 6 months, but you also qualify with other circumstances. But you do provide 50% of the support for another individual for at least half of the year. So head of household, you have a single taxpayer, you're separated from your spouse, but you provide 50% of the support for another person. If you're single, that's what you file, and married filing separately, you elect not to have a joint return. Married filing separately is one of the highest tax brackets. So not too many people file married filing separately. There are situations and circumstances where you have to. So now gross income is basically all of your income unless it is specifically included by statute, which are very few. So any money that you make in your salary, which is usually reported on a W-2, or if you're self-employed, that would be your Schedule C. Interest and dividends is usually your Schedule B if you received alimony. And if you're lucky enough to win the lottery, you get to pay taxes on that also. So all of these items are included in gross income. The most important is compensation, any compensation that you have. If you made money from a business, interest is also common. Dividends, if you have Schedule C for your capital gains and losses. If you have unemployment compensation, you do have to report that. Pensions, any share of income, and then trusts or estates. And we're going to talk more about trust and estates and the income associated with that. Now, there are some exclusions from gross income, which is basically scholarships and fellowships, return of your original investment, and basically up to $50,000 of group life insurance you don't have to include in that, and employer reimbursed of an employee-related expenses. There is, I believe it's Form 2160, unreimbursed business expenses. If you do travel for of your company and you don't get reimbursed for everything, you can do that. But if you are reimbursed, then you don't have to include that as part of your gross income. If you have damages for personal physical illness or injury, also if you receive under health or accident insurance, if you receive payments, that is not taxed. You also might have certain employee benefits like health insurance and cafeteria plans that you don't have to pay taxes on. Child support is also exempt from your gross income, and some qualified Roth IRA distributions. So the key to gross income is know what's included and what isn't, because that is quite a few questions on the CFP exam. You'll see that also on our exam. Now, imputed income is you'll report income even though they don't actually receive it. So for example, if you loan $10,000 or more and you charged less than the applicable federal rate, then you would have that as imputed income. If you purchased an original issue discount bond or a zero coupon bond, or if you sold an asset on an installment sale without charging interest, then that would be reported as income even though you didn't get it. These are also rare situations, but could be a dilemma where we talked about the audit previously. And if you don't report it and there's some discrepancies, you might be susceptible to an IRS audit. So AGI is your new best friend. That's your adjusted gross income. And here you take your gross income, and then you're allowed to take specific items that are listed in the the Internal Revenue Code. Now, this is your preliminary measure, and this is what you pretty much use for all calculations. So you get your AGI, you use your itemized deductions against that, you take away your tax credits, and you also know what other amounts are deductible. For example, there's a percentage, 2% of AGI for your medical expenses. So deductions that reduce AGI are obviously the most valuable because then you pay less taxes on those. Now, deductions for adjusted gross income, we call this above the line. They're usually on the first page of the 1040, right? And self-employment taxpayers, right? If you have contributions to retirement plans, 100% of the premiums for your health insurance is deductible, and then you have 50% self-employment tax. Then you have deductions for students and teachers, so you can add all of your students now, so you can take up to $2,500 interest on your qualified education loans. You also have up to $4,000 of certain qualified higher education expenses. If you are not taking this now, you may want to look at the IRS code and see if you qualify. Then you have deductible items. So you have up to $5,500 or $6,500 if you're over 50 for your regular IRA contributions, any alimony that you paid, if you have unreimbursed moving expenses for job relocation, your HSA accounts and MSA accounts. And there's also a penalty of early withdrawal of savings and domestic production activities. So these are great because they're above the line. You take them, it's a dollar for dollar practically, a reduction of your gross income to get to your AGI. Now, standard deductions for 2016, we're looking at basically $12,600 for married filing jointly, and single is $6,300. And then you see that taxpayer who qualify as a dependent on another tax return, you take the greater of $1,050 or the amount earned, plus $350, but not more than $6,300. So this is changing every year, and you just want to make sure you know the amounts, so that way you know if you're single, if you have more than $6,300 of standard of itemized deductions, you're going to itemize. That's the purpose. If you can't itemize, you use the standard deductions. If your itemized deductions are greater, then you use the itemized ones. And here we have medical expenses in excess of 10% of AGI. That's considered an itemized deduction. Your property taxes, including state and local taxes. Your mortgage interest. Property taxes and mortgage interest are the two most common itemized deductions. If you have charitable contributions, you would include those, gambling losses, and you also have like miscellaneous deductions in excess of 2% of AGI. These thresholds of AGI makes it a little bit more difficult, so hence why charitable contributions and taxes and mortgage interest are the absolute most common itemized deductions. For medical expenses that can be paid for you, the taxpayer, or your spouse or any dependents, you have health insurance premiums, you have prescription drugs, but not over-the-counter drugs. You may have some clients try to get you to do that. And then you also have any unreimbursed health or dental insurance. But now only the amount over 10% of the AGI is deductible. So that makes it a little bit difficult. If you're making $100,000, then that would be $10,000. And unless you're very sick, you wouldn't have that. So not as common unless somebody within the exemptions are super sick. Then you have property taxes, which I mentioned, that are deductible. So real estate, automobiles, boats and trailers, your state and local taxes. And here most people forget about their auto. I mean, it might be a nominal amount, maybe $50 to $200, but it still adds up and it's deductible if you're able to itemize. So make sure you are aware of that. Then you have interest expense, right? So personal interest is not deductible. So that interest on your credit cards, no. But your mortgage interest is. And then if you have delinquent taxes, that's not deductible. Your investment interest is deductible, but only to the extent that you have income on that investment. And then interest incurred to produce tax-exempt income is not deductible. So the key to interest is know which ones are deductible and which ones are not deductible. Because there are questions on your midterm with that and also on the CFP exam. So your qualified mortgage interest are on loans used to acquire, you can have up to 2 homes. So if you wanted that vacation home, you can deduct. But the total acquisition loans, it can't exceed $1 million, and interest paid on refinanced loans is also deductible. So some people miss that. So if you're refinancing and you have interest that you paid, that's deductible. And interest on home equity loans is also deductible, but it can't exceed $100,000 or the fair market value of the home. And then any points that you paid are to improve your primary home. This is your primary home. Those are deductible. But points paid on refinancing, you can amortize over the life of the loan unless it's for substantial capital improvement. So if you're taking out a home equity loan to have an addition, that might work. So now we have just mortgage interest examples. If you have the following income and expenses, how much should you deduct as your marginal interest expense? And basically, this will allow him to use the 15% tax rate, right? So we're looking interest income, right? Marginal interest expense, interest income, dividend, and etc. So this is just a good example. You'll get plenty of practice with all of your multiple choice questions at the end of our topic. Now, charitable contributions we have is basically to any public entity, the Red Cross, the Salvation Army, and cash is deductible up to 50% of your adjusted gross income. Then you have long-term capital gain property that's up to the fair market value of 30% of the AGI. If you have a private charity, you can deduct 30%, and then long-term income goes down to 20%. You must have a receipt for all gifts over $250. And the contributions that are limited may be carried forward for the lesser of 5 years or death, which is kind of morbid, but hopefully that does not happen. So we are actually going to stop here and pick up in our next video.